I have to be honest, I almost didn't want to bring this deep dive to the table today.
Oh, why is that?
We spend so much time talking about strategies, indicators, how to find that edge in the Forex markets. And then I get this slide deck, this research, and it basically tells me that everything I've been looking at on my screens for the last 5 years is a hallucination. It feels personal.
It is personal. It's an attack on your biology. But before you throw it out, remember who wrote it.
Right.
We aren't talking about some Twitter guru selling a course here. This is from a veteran financial data scientist.
How long in the game?
35 years. And he's back-tested over 10 million real trade data points.
10 million. Okay. That is a sample size that's, well, it's hard to argue with.
It is.
But his conclusion is just so bleak. He's saying the reason most traders fail, and we know it's something like 95%.
Yeah, the numbers are brutal.
It isn't because they don't know enough. It's because they're human.
That's the core thesis. In his words, your hardware is obsolete.
Obsolete hardware. Wow.
He argues that the human brain is this incredible pattern recognition engine, optimized for the African savanna, not for the stochastic chaos of a EUR-ISD chart.
So when I sit down to trade, I'm running this super complex financial software on an operating system that hasn't had an update in 100,000 years.
That's a perfect way to put it. Yeah.
So let's unpack this, because I look at a chart and I don't feel like a caveman. I feel like an analyst spotting a Head and Shoulders.
Of course.
But he starts with this evolutionary mismatch, the whole line in the grass thing.
Right, but we need to go deeper than the kid's story version of that. Think about the neurochemistry. You're a hunter-gatherer. You hear a rustle in the grass.
Okay.
Your brain doesn't weigh the probabilities. It screams lion and floods your system with cortisol. You run.
And if it was just the wind?
You feel a little foolish. You burned a few calories.
Yeah.
But you're alive.
Right.
The cost of a false positive, seeing a pattern that isn't there, is tiny. But the cost of a false negative, ignoring the rustle when it is a lion,
is
death. So evolution wired us to be hypersensitive. We are machines built to find signals in noise. We have to connect the dots. It's survival.
I get that for survival. But why doesn't that make me go broke trading the British pound?
Because the market isn't the savannah. And the source has a very specific statistic here.
What is it?
In the short term, price movement is about 90% random noise.
90%.
It's basically a random number generator. But your brain, your ancient software, it just can't accept random. It looks at the chart, sees a squiggle, and that old program kicks in and goes, that looks like a double top. That's a lion. Sell.
So the signal I think I'm seeing is just my brain trying to save me from a threat that doesn't even exist.
You're seeing patterns in static. A cognitive hallucination. Which brings us to the first big diagnosis in the deck, pareidolia.
Pareidolia, I know this one.
That's seeing faces in clouds, or, religious figures on a piece of toast.
Exactly, or support and resistance lines on a chart. Whoa, hold on. You can't. You can't just lump support and resistance in with Jesus on toast. Those levels are real. I mean, big banks watch those levels.
I'm just telling you what the 10 million data points say.
And what do they say?
When this scientist programmed a computer to trade strictly based on these classic geometric patterns, head and shoulders, wedges, all of them, with no other context, the results were statistically identical to a coin flip.
That is really hard to swallow, because I can pull up a chart right now and I can show you a perfect bounce off a trend line. It looks like physics.
It looks like cause and effect because you're looking backward, in hindsight. But the data shows for every perfect bounce you remember, there are dozens of times the price just sliced right through that line.
And my brain just ignores those.
It categorizes them as noise and deletes them. You're trading a hallucination. The market didn't respect your line. You just drew a line where the market happened to turn.
So we're just imposing order on chaos to make ourselves feel in control?
Precisely. We crave certainty. And a chart pattern gives us this illusion of certainty. If this happens, then that is guaranteed. It soothes the anxiety of the unknown.
But the market feeds on that anxiety.
It's a machine that eats it.
Yeah. Okay, this gets worse. The second diagnosis, the clustering illusion. This part of the presentation actually made me laugh because it described my Tuesday morning perfectly.
Ah, the fake trend scenario. Let's hear it.
Okay, so you're staring at the EUR-ISD. It's been dead all morning, just chopping sideways.
Rage-bound, yeah.
Boring. Then all of a sudden, bang, a big green 1-hour candle. Then another one.
And what does your brain immediately do?
It wakes up, it screams, momentum, The institutions are buying. The train is leaving the station. I see 2 green candles, and I just assume a third one is inevitable.
Oh, you buy.
I buy at 1.1065, completely convinced I've caught the breakout.
And this is where the cold, hard math just humiliates our intuition. The source calls it the clustering illusion. In any truly random data set, like flipping a coin, streaks are not just possible. They are statistically inevitable.
Explain that. Because 2 green candles feels like a trend, not a coin flip.
Okay, if I give you a fair coin and you flip it 100 times, you are statistically guaranteed to get a streak of 5 or 6 heads in a row at some point.
Okay.
When that happens, do you say the coin has momentum? Do you say the coin is bullish?
No, of course not. It's just a coin. It's random.
But on a chart, you see a random cluster of buy orders, which happens all the time, and you invent a story. The euro is strong today. You buy at the top of that cluster.
And then the coin flips tails.
And the price reverts back to the mean. It drops back to 1.1035. You get stopped out, and you're sitting there confused thinking, but the signal was so strong.
When there was no signal at all, it was just a random cluster.
You were betting on a streak and a random walk. And that leads to the third and maybe the most dangerous diagnosis, confirmation bias.
The ego trap.
The ego trap.
Yeah.
This is the one that prevents us from learning.
How's it work?
It's the mechanism that protects your self-esteem at the expense of your trading account. Let's say you're a big believer in the Golden Cross.
Yeah, the 50-day crossing the 200-day. It's a textbook strategy.
It is. Now, you take 10 trades based on it. Let's say 5 work, 5 fail. What does your memory do?
I remember the winners. I remember that one trade that paid for my vacation. I felt like a genius.
And the 5 losers?
I explain them away. Oh, the Fed spoke that day, or I got in a bit late, or the market was just manipulated.
Exactly. You delete the data that contradicts your belief. The source argues traders are not collecting data to be right. They're collecting data to feel good.
So I'm building a whole thesis on an exception and just ignoring the rule.
You are. If you actually logged every single Golden Cross over 20 years, which this data scientist did, you'd see it has no predictive power on its own. But your brain won't let you see that.
It sounds like we are constantly gaslighting ourselves or fighting our own biology. So if the market is mostly random and our brains are hallucinating, how does anyone make money? Should we just give up?
No, not at all. But it demands a complete shift in your worldview. And the source introduces this with a section called the cold reality.
Okay.
Using the concept of the drunkard's walk.
I've heard this. It's like brownie in motion, right?
Yep. Imagine a drunk guy stumbling out of a bar. He takes a step. Maybe left, maybe right. Just because his last step was left, does that give you any real information about his next step?
Not really. He's drunk. He could fall over for all I know.
That is the market. The source basically says future price movement is a 50-50 probability event, largely independent of the last price move.
Okay, I have to push back on that. Seriously. If the market is a pure 50-50 random walk, then the casino model you mentioned earlier doesn't work.
Go on.
A casino makes money because it has a statistical edge. The little green 0 on the roulette wheel, it's not 50-50, it's slightly in their favor.
Right.
If the market is truly 50-50 and I have to pay spreads and commissions, I'm mathematically guaranteed to lose over time. I can't be the casino if there's no edge.
That is the critical realization. You are 100% right.
So, what gives?
In a pure random walk, you can't win. But the source clarifies this with chaos theory. The market is mostly random noise, but it has fat tails.
Fat tails.
Rare, extreme events, trends. The drunkard usually just stumbles around the lamppost, but every now and then he stumbles 3 miles straight down the road. The edge isn't in predicting the next stumble. That's impossible. The edge is in how you manage your risk during the stumble.
So we're not predicting where the drunk goes. We're just betting that if he starts walking straight, we go with him, and if he falls over, we get out instantly.
That is the entire shift, from being a prophet to being a risk manager. And that brings us to the protocols for survival. And these aren't tips. These are rigid rules to override your faulty biology.
Protocol A is pretty blunt. Kill your instincts.
It means stop trusting your eyes. Your eyes are, as he calls them, biological liars. They want to see the head and shoulders. You have to replace your eyes with data.
With backtesting. And he doesn't mean just looking back at the chart. He means rigorous simulation.
Absolutely. If you think a pattern works, you have to code it or manually test it over hundreds, even thousands of trades. And the rule is simple. If a strategy lacks statistical significance in a backtest, it is not a strategy.
It's a religion. You're praying, not trading.
You're just wishing. Okay, so then protocol B, the casino model.
This goes back to what we were just saying about the edge.
Right. The casino doesn't care about a single hand of blackjack. It cares about 10,000 hands. It knows the math will play out over a large sample size.
But traders get obsessed with the no. I have to win this one trade.
And that desperation leads to the biggest sin in trading.
Moving your stop loss.
Financial suicide. The source lays out the math of recovery. Every trader needs to see this. If you lose 10% of your account, you need an 11% gain to get back. That's manageable.
But if you hold on to that loser because your ego is screaming, it has to come back, and you lose 50%.
You now need a 100% gain just to break even. A 100% gain, you have to double your account just to get back to zero.
In a market that's mostly random noise.
You're asking for a miracle. You've dug a hole so deep the math itself is working against you.
So the casino model is about betting small enough that no single loss can kill you, and folding bad hands immediately.
Ruthlessly. You cut the noise, the small losses, without hesitation, so that when that fat tail, the big trend finally shows up, you still have chips on the table to ride it.
Okay. And finally, protocol C, externalize the process.
This is all about removing you from the equation, taking your emotions, your gut feelings out of it. He suggests a digital pre-flight checklist.
Like a pilot.
Exactly. A pilot doesn't hop in a 747 and say, I feel like the engine is probably fine today. They check the sensors, they follow the protocol.
And for a trader, that checklist is what?
Is my entry criteria met? Is the risk-to-reward ratio at least 1 to 2? And the biggest one, am I emotionally compromised?
Yeah. Am I trading because I see a real setup, or because I'm bored and I want a dopamine hit?
Or because I'm trying to win back the money I lost yesterday? Revenge trading. That's your primitive brain trying to fight the lion. The checklist forces you to slow down and engage your logical brain before your lizard brain clicks the mouse.
The source also talks about scientific skepticism, trying to disprove your own trade idea.
That's the antidote to confirmation bias. Before you click buy, you have to actively search for 3 solid reasons not to take the trade.
That's the opposite of what most people do.
Of course. Most traders look for reasons to say yes.
Yeah.
You need to look for every reason to say no. And if you still can't find one, then maybe, just maybe, it's a valid trade.
You know, listening to all this, it really strips all the glamour out of trading. There's no secret pattern, no magic indicator.
It's boring. And that's the whole point. The source mentions that secret pattern equals 1,000% returns videos get millions of views.
But risk management 101 videos get ignored.
Because real trading is closer to being an actuary than being some kind of artist or hero.
The verdict from the source is pretty heavy. He says, the market is a machine that transfers money from the emotional to the disciplined.
It's just true. The market is brutally efficient at punishing basic human nature. Your instincts are perfectly calibrated to make you lose money.
So the whole mission isn't to master the market, it's to master yourself.
You have to acknowledge the glitch in your own software and then build systems to override it.
Okay, before we sign off, I want to leave everyone with the challenge from the end of this deck. It's a bit uncomfortable, but
This is necessary.
go look at your last 10 losses, pull up the charts, and be brutally honest with yourself. How many of those times was the market rigged or crazy?
And how many times did you just see a line where there was only grass?
Did you trade a pattern that wasn't really there? Did you chase a streak that was just random noise?
If you can answer that honestly, you're already ahead of 90% of everyone else.
Kill your instincts. Trust the data.
That's the only way.
A tough reality check. We'll see you in the next deep dive.